Good morning, everyone. Welcome to the Fund Finance Expert Talk. I'm Mbayi, Head of Bank and Finance of Praxio. And today you have the pleasure to welcome Ian Wiese. Hi, Ian.
Hey, Michael. Thanks for having me.
It's a pleasure to have you with us. Can you first further introduce yourself and your firm?
Yes, of course. So good morning, everybody. I'm Ian Wiese. I'm a Managing Director in the Barings Portfolio Finance team. It's worthwhile saying that, from Barings' perspective, we are $470 billion AUM asset manager, really across private credit and adjacent strategies. And we are a subsidiary of MassMutual, one of the larger insurance companies in the world, which is a nice segue, I suppose, Michael, to kind of at some point in time discuss insurance and fund finance and portfolio finance. But our team is a team of close to 40 individuals, and we manage about $30 billion of AUM.
Mm-hmm. And can you tell us how you get into fund finance?
It's quite an interesting story. We have to go to the southern part of Africa, Johannesburg, and I was working in a team really focused more on structured solutions through lending and equity solutions. And got a phone call from our London balance sheet saying, well, the fund finance market is picking up. They need more balance sheet. Can South Africa help? And I was one of two individuals starting to underwrite fund finance transactions a bit more on the side of my day job. And quickly, within 2 years, I moved to London, and that's more than a decade ago. So it really started with, as the market grew in the kind of 2012, 2013, we needed more capital as a bank at that point, and it was really the catalyst of actually moving to London and really start my journey quite early on in the fund finance space.
Mm-hmm. And in a career, there are defining moments. What were your defining moments?
I used to be a lawyer, and that was probably a defining moment early on. I realized 4 years into my journey that whilst I was passionate about law and it was a great school to learn across the various disciplines, I wanted to do something different. And at that point in time, I was still young. I spoke to my partner, and we had a whiteboard, and we looked at the pros and the cons of changing careers. And one of those defining moments was really kind of surrounding yourself by good leadership that's got your best interest at heart. And that partner had my best interest at heart, and kind of worked with me as I was exploring changing careers. And it ended up the day I resigned, I went into the chairman's office, and it's the largest law firm in Africa.
Mm-hmm.
And he said to me, Ian, never sell yourself short. And those words always resonated with me as a young individual at the beginning of your career, to back yourself, push yourself, and don't sell yourself short.
And you are obviously active in the private credit space. If there was a young professional wanted to enter into the space, what type of advice would you give?
So yes, our business, about 30% of what we do is underpinned by private credits. So it's a very important part of what we do. The private credit markets more generally had a lot of tailwinds, really growing at rapid rates as they effectively, replaced bank finance in that portion of the market. So for a young individual, it would really be to learn as much as possible across asset classes. Build relationships not only within the firm, within the private credit firm, but with the sponsors, because your technical knowledge is the foundation to what you do, but it's those relationships that you build over time that will open doors. So as much as you want to kind of be a technical expert, which is great, never let relationships fall to the wayside. Invest in those relationships, because that might be the new largest credit manager, that might be a spin-out manager. And more importantly, if you happen to find yourselves in portfolio finance or fund finance, it's those relationships that will open even more doors. So it's kind of the technical foundation, but also back yourself and push yourself to be at the forefront of innovation in the private credit industry, because even where we are today, it's not a static industry. It continues to evolve, and you want to make sure that you're on that wave, riding that wave of evolution, and not lag behind.
I totally agree with you regarding the relationship aspect. Uh, you can be in a bank, in a private credit fund, or in a law firm. In our actual industry, relationship is key. Your client today is maybe your boss tomorrow, or your boss today is maybe your client tomorrow. So it's important, yes, to cultivate those relationships indeed.
And I think, Michael, one of the things that we need to, maybe those of us got a bit more gray hair, we see that things take time. You invest in a relationship. It doesn't have an instantaneous payback period. But if you continue sowing into that relationship, the time will come. I always encourage our younger generation to say it might not be 1 year, might not be 2 years, it could be 7 years. But when that little seed sprouts and that first transaction comes into fruition, it's a very satisfying moment in your career. So it's not building short-term relationships, really investing for the long term. And I think, maybe that's maybe of an investor mindset. We don't want to invest for the short term, we want to invest in the long term, but that starts with the relationships.
Mhm. And arguably, you are one of the leading figure of the fund finance industry. Currently in the market, what are the trends that you see?
I think the fund finance market is quite broad. So, I think from our perspective, we very much focused on portfolio finance, which is more looking at portfolios of assets rather than, for example, undrawn capital and sublines. But I think even if you look and you segment that, so if we start with subscription finance, which is an area, I grew up in as well, and had a lot of exposure to, that market was traditionally a banking market and a banking market only. I think what you've seen there is a lot of innovation where institutional capital has accessed the market, and where the products within subscription finance have been tailored to suit institutional needs. So from that perspective, that innovation is continuing to grow. In fact, I'm quite proud that some of my ex-colleagues are at the forefront of really introducing institutional capital into subscription finance. When we go to the portfolio finance, more looking at the portfolios, whether it's private credit, whether it's private equity, again, what we've seen is not only has the lenders become much more sophisticated. Not only do you have bank lenders, you've got insurance lenders like ourselves, you've got other institutional lenders, but the managers themselves have become much more sophisticated. No longer is it an overdraft, it's portfolio management, it's returns management, it's distribution management. So we've seen not only has the market grown in size, but in sophistication, and ultimately to really fill gaps in specific needs. And that's why, when I started, when you were looking at a subscription line or a NAV line, you would be speaking to the partners of those sponsors directly. Now there's a whole capital markets team that is really kind of the face that you speak to, because there's so many considerations as they look at various ways of using this asset class for their benefit. So I think it's really the growth from banks to non-banks, but also the use case of sponsors really identifying the needs and what we can do for them, and then matching the solution with a need. And that has kind of ballooned the industry, which will continue to grow at I believe, double-digit rates.
Mm-hmm. In terms of secondaries, what are the trends?
It's an area of the market which I'm quite passionate about. It's also incidentally one of the fastest growing sub-asset classes within the private markets. If we just think about volume, $70 billion 5 years ago, forecast this year will be in excess of $200 billion. So the market has really grown, and there's a number of reasons, and we can look at some of the factors. The first reason is there's significant NAV in the ground in the private market universe. We are in time of our lives where distributions or liquidity remains subdued. So M&A activity is just not at the levels that we used to. That has resulted in institutional investors effectively needing liquidity to essentially invest into newer vintages or to rebalance their portfolio as the value of private market assets have grown, and they've got certain parameters in terms of exposure to privates which they have to adhere to. Not only that, you've seen the secondary market not only just being relevant to private equity secondaries, you've seen the growth of credit secondaries, real estate secondaries. So you've seen asset classes and the secondary market being able to be relevant to all of these asset classes. Then you've had the advent of continuation vehicles, which we speak about every day, where a GP identifies an asset or a couple of assets, realize that there's no M&A activity. It needs to appease its investors, but it also wants to hold on assets that it knows best and that it believes that will grow over time. So I think if you take all those ingredients and you mix them together, it's really a great recipe for future success. I think we will get to a stage where there might be the outperformers and the underperformers. Everybody's done reasonably well. We're also seeing a bit of a bifurcation in terms of fundraising. You are seeing the larger secondary funds being able to raise successor funds at even greater scale. And you see the mid-market secondary managers, having to work a bit harder. And then the last, kind of evolution within this industry is kind of, if you think about corporate acquisitions, you've seen Franklin Templeton buying into Lexington. You've seen more recently, I think it's 3 weeks ago, State Street announcing that it's investing in a minority stake into Collar Capital. So you're seeing a lot of movement in terms of asset managers and how they align themselves, that they don't only have the primary side but also the secondary side, which I think from a holistic offering is a great thing, but it does require different skills, and I think those managers just need to ensure that that they have those in-house skills, because it's different from underwriting a primary investment to being a secondary buyer, and that comes with the territory.
One point of discussion that there is a lot on the market currently is the impact of insurance money in fund finance. I'm interested about your perspective on that.
Well, that goes back to kind of our heritage at Barings, and our little team started at MassMutual back in 2017, and it was really to allow the general investment account of this insurer to gain access to investment grade assets underpinned by private market assets, and the team quickly realized that it was a really good fit, and that grew from a standing start back in 2017 to where we are today, with over 30 billion of AUM. Now, what we did realize about 2 years ago is that if we're going to have the growth aspirations which we have, MassMutual will continue to back us, but they can only back us depending how fast their general investment account grows. And if we want to grow faster, we'll have to access third-party capital. So about 2 years ago, the team moved from MassMutual into the Barings umbrella, and over the last 18 months, we've raised over $6 billion of third-party capital to really allow us to be the interface for other insurers, kind of giving them access to this asset class. And the reason why insurers are so interested is when they look at things, they look at how does this comp with public investment grade credit, and that relative return or that spread pickup that this asset class in the private markets offer is really attractive. So from our perspective, we not only kind of managing MassMutual now, we've got a lot of great partners in terms of other insurers and other institutional investors. And you've seen Apollo Athene, you've seen Ares and some of their insurance clients. I think we quite unique in the sense we came from an insurer that owned an asset manager rather than an asset manager acquiring an insurer. So that's a slightly different. I think the fact that insurance money from a timing perspective is really attractive to the private markets. If you think about it, Michael, it's not PE or private equity. It's not I buy something, I sell it tomorrow. It's a long-term strategy. And not only you had the closed-ended regime, you now have evergreen funds, which means, they last forever, in some way or form. And insurance capital is very well suited to those long-term solutions because ultimately you're matching either with annuities or in our case, it could be whole life policies. Roger Crandall, the CEO of Mass Mutual, meant I think the longest policy that we've got at the moment at Mass Mutual is over 100 years. So I'm not saying I'm going to write a 100-year loan, but the fact is I have the ability, we have the ability to really match the maturities. And I think that is unique to insurers, whereas, as we know, I come from a bank, spent over a decade at a bank. There it's, capital efficiency, wanting to churn assets, and often that doesn't align with the behavior of the private equity and private credit industry.
Thank you very much, Ian, for your time today and for your insight. And thank you as well to the audience for your time, and see you soon for next fun expert talk. Bye bye. Cheers. Cheers.